What they aren't telling you about 3i Atlas, you might have seen the name 3i Atlas, maybe in passing, buried in some business news feed, or trending among finance-focused corners of the internet. The coverage feels sparse, technical, perhaps even impenetrable, but behind that name 3i Atlas lies a story more complex than most investors or business analysts would like to admit. So let's start with the basics. If you've gotten this far, you probably know that 3i, officially known as 3i Group, has a long history as one of Europe's largest private equity and infrastructure investment firms. Headquartered in London, 3i has been around since 1945, originally seeded to help reboot the UK economy after World War II. For decades, it stayed in the relatively staid lanes of venture capital and growth investments. Think infrastructure, retail, healthcare, small manufacturing, not exactly headline-grabbing stuff. But then, in the early 2010s, the global investment world began to change. Ultra-low interest rates and quantitative easing meant that enormous pools of capital were searching desperately for any return beyond a paltry government bond. Infrastructure, long a sleepy corner of investing, went from unfashionable to the next big thing. A well-managed road, airport, or port, after all, can throw off stable, inflation-protected cash flows for decades. Competition heated up, margins narrowed, but the game got hotter. Enter Atlas. In late 2017, 3i Group acquired a significant interest in an existing infrastructure management platform, rebranding and restructuring it as 3i Atlas. This new entity wasn't meant to be just another holding company or fund. The strategic plan, as stated in investor reports and flowery press releases, was clear: use Atlas as the spearhead for 3i's ambitions to become a dominant global player in infrastructure operations and management. But what isn't immediately obvious, what most reporting on 3i Atlas glosses over, is just how transformational and potentially risky this move was for the entire firm. Let's peel back the first layer. Most people understand infrastructure as bridges, highways, or perhaps even the occasional wind farm. What they don't see is that the infrastructure business at a global scale is a matrix of political relationships, long-term contracts, regulatory sand traps, and shifting government priorities. The very stability that attracts conservative investors to infrastructure hides a labyrinth of deals, backroom negotiations, and arcane risk models. When 3i Atlas launched, a large part of its immediate growth was achieved not through patient construction of new roads or green energy projects, but through a series of bold acquisitions, especially in continental Europe and North America. One example, their buyout of the regional logistics network in the Benelux region, previously owned by a patchwork of local investors and municipal governments. Another, the surprising move into North American water utilities, an asset class that's highly regulated, easily politicized, and in the post-Flint era, fraught with local distrust. On paper, these acquisitions offered exactly what investors were craving: steady, regulated returns and built-in inflation hedges. But dig just a little deeper, and you begin to see the cracks. First, there's the balance sheet. In order to win these deals, 3i Atlas has been willing to bid aggressively, sometimes at eye-watering multiples of book value. The simple reason: the global chase for yield has driven up asset prices to unsustainable levels, and only the most ambitious or well-funded players can afford to keep up. Look at investor briefings, though, and these high purchase prices are written off as synergies yet to be realized or unlocked value through operational improvement. These are accounting euphemisms. In plain English, it means 3i Atlas is betting it can run these assets more efficiently than the previous owners, or extract new forms of profit from them. That brings us to the second, less visible risk: leverage. Nearly all major infrastructure managers use significant debt to juice returns, but in the case of 3i Atlas, the amount of leverage has, according to some market insiders, crept uncomfortably high. While they tout the stability of regulated cash flows as justification, recent interest rate hikes, especially in the US and Europe, mean that the cost of servicing this debt has climbed sharply, and unlike other sectors, infrastructure revenues can be slow to adjust. Water utilities and road tolls are often locked into multi-year agreements, meaning rising costs have to be absorbed, at least for a time. But the most crucial aspect, the thing almost nobody seems to say outright, is just how dependent 3i Atlas's new business model has become on financial engineering, that is, reworking how profits and risks are distributed among myriad financing vehicles, joint ventures, and subsidiaries. Instead of being a straightforward own and operate model, 3i Atlas spins up complex partnership structures: Layer A owns Layer B, which licenses back to Layer C, and so forth. On one hand, this can optimize tax and improve capital flexibility. On the other, it can hide operational losses, transfer risk to lightly regulated shells, and muddy the true financial picture. Investors and analysts now have to play detective with every annual report. For example, the surge in profits reported in the 2022 to 2023 fiscal year was the result of a combination of fair value adjustments on new acquisitions, alongside unrealized gains from strategic repositioning of assets. If you look closer, most of that profit wasn't cash hitting 3i Atlas's bank accounts. Instead, it was a theoretical boost in asset value according to in-house models' paper gains, which can evaporate if those optimistic assumptions are challenged by real-world events, and those events have started to materialize. Supply chain disruptions, unexpected regulatory changes, and a populist backlash against privatization of essential services, especially in water and transport, have already forced 3i Atlas to write down or quietly sell off several high-profile assets. Case in point, in early 2024, their North American water utility subsidiary reported a substantial loss after state regulators imposed new quality standards and capped price increases. That unit, once hyped as a pillar for future growth, is now a management headache, exactly the kind of risk the initial glossed-over prospectuses didn't highlight. None of this is to say that the 3i Atlas strategy is doomed or even necessarily reckless. There's a logic to their play, as governments everywhere struggle with debt and investment shortfalls. Private operators like 3i Atlas do fill a real, often urgent need. Well-managed infrastructure can transform communities and drive economic growth. And to their credit, 3i Atlas's operational teams have delivered genuine improvements in certain areas: streamlined logistics, digital upgrades, greening initiatives in old assets, and better regulatory compliance, at least when oversight is tight. But what's telling is the firm's communications strategy. The messaging remains relentlessly upbeat, focusing on long-term vision, ESG commitments, and selective success stories. There's almost no public acknowledgement of project-level struggles or any hint that global macro conditions could upend the entire model. For shareholders and institutional clients, the pension funds, insurance pools, and sovereign wealth vehicles who supply the bulk of 3i Atlas's capital, this creates a false sense of confidence. The caveats and footnotes buried deep in quarterly filings rarely make the morning business news. Here's another dimension that seldom gets airtime: geopolitics, infrastructure assets, ports, airports, utilities are becoming, once again, strategically sensitive. Political tides have shifted since 2020. Governments are more nervous than ever about foreign ownership of critical infrastructure. Some countries have threatened or even enacted forced divestment or increased regulatory hurdles for private equity-backed owners. 3i Atlas knows this and has in recent years tried to preempt such moves by courting local partners or carving out subsidiaries to satisfy regulators. But this dance is both delicate and expensive, and every new rule shrinks profit margins. So what aren't they telling you about 3i Atlas? It's not that the business is secretly failing or that disaster is inevitable. It's that the risks are more pervasive, systemic, and interconnected than those glossy reports or PowerPoints let on. 3i Atlas is a case study in what happens when global finance meets the practical, messy world of public service. Their returns so far have depended on a perfect storm of cheap money, investor demand, and benign regulation. But the world is changing, interest rates are rising, anti-privatization sentiment is growing, and governments are flexing newfound power. If you're an investor, a public policymaker, or even just a citizen who rides on those roads, drinks that water, or relies on that power grid, it's worth asking where the next risks may lie, not just the visible ones, the wonky numbers on page 5 of the report, but the hidden vulnerabilities that come from complexity, leverage, and the unrelenting chase for yield. 3i Atlas isn't the only player in this space. Similar dynamics play out at every major global infrastructure fund, but their experience and the limited transparency around their strategy are a cautionary tale. When you next see a headline trumpeting record infrastructure profits or 3i Atlas delivers robust growth, remember, most of the real story happens after the press release, in the footnotes, and sometimes far from public view. In the world of infrastructure investment, as in all things, what you don't see is at least as important as what you do. And for 3i Atlas, the part they aren't telling you deserves your close attention.